There are three major categories of investment. The first category is anything denominated in a currency. It can be bonds, it can be deposits in a bank, it can be a money market fund, it can be cash in your pocket. The second category of investments, items that you buy that don't produce anything, but that you hope someone will pay you more for later on. The classic is gold. The third category of asset is something that you value based on its what it will produce, what it will deliver. You buy a farm because you expect a certain amount of corn or soybeans or cotton or whatever it may be. You decide how much you pay based on how much you think the asset itself will deliver over time.
How to double your money using the Rule of 72. Albert Einstein held the belief that the Rule of 72 was a more significant discovery than his theory of relativity. The origins of this rule can be traced back to Luca Pacioli, known as the father of accounting, who first mentioned it in his 1494 book, Summary of Arithmetic, Geometry, Proportions, and Proportionality. In this book, Pacioli explains the rule's importance. Stay until the end of the 8 ways the rule can help you, and gain what everyone else is missing. If you're finding value in our videos, press the like button to like this video. Subscribe to the channel. Tap the bell icon to stay connected to great insight. Leave a comment to let us know how this helps you. Doubling one's money in a short period of time is a universal dream. Who hasn't wished upon a falling star to wake up with a 6-figure bank account? We are here to tell you that this dream can become a reality. It is not a figment of your imagination. In today's practical wisdom video, we will discuss the Rule of 72. If you're finding value, leave a comment, subscribe to our channel, press the like button, and stay connected to a community of like-minded people. Number 1. The Rule of 72. The Rule of 72 is a valuable tool for setting financial objectives, analyzing economic trends, planning for financial goals, evaluating investments, and managing debt. It works by determining the time it takes for an investment to double at a fixed interest rate. To calculate it, divide 72 by the desired rate of return. For example, if you aim to earn a 5% interest rate, divide 72 by 5, which gives you 14.4. This means it will take approximately 14.4 years to double your money. There are numerous benefits to using this rule. It allows you to quickly and easily assess whether you are keeping up with trends and making sound financial decisions. It can also be used to calculate inflation, as it shows how long it will take for the value of your initial investment to have. Don't forget to subscribe to this channel, press the like button, leave a comment about how this adds to your life. Let's get back to it. However, there are some limitations to consider when using this rule. It can only be applied to assets that calculate compound interest annually. Additionally, it may not accurately calculate rates below 6% and above 10%. Nevertheless, don't let these disadvantages discourage you from using the Rule of 72. Consult a financial advisor who can provide a more in-depth explanation and guide you appropriately. Number 2. Compound interest. As mentioned earlier, the Rule of 72 is applicable only to compound interest. Understanding this rule and the power of compound interest is the key to financial growth. Now, let's delve deeper into compound interest. The longer your money is invested, the greater your earnings will be. The interest earned on your initial investment is added to the principal, creating a cycle of continuous growth. In simple terms, invest your money and forget about it. To determine how long it will take to double your current savings, use the Rule of 72. Divide 72 by the interest rate, for example 6%. The result, 72 divided by 6 equals 12. This means it will take approximately 12 years to double your money. When considering compound interest, look for higher interest rates, as they will expedite the doubling process. Consult a financial advisor to find the best compound interest options, and use the Rule of 72 to accelerate your wealth accumulation. Number 3. Investments. The Rule of 72 can also be applied to evaluate your investments. At some point in life, we all consider making investments, and this rule can provide valuable insights into the time it takes for your investment to double. Whether you invest in savings deposits, government bonds, mutual funds, or stocks, the Rule of 72 can guide you as long as you factor in compound interest. To better understand this rule, let's consider the following scenarios. Investment 1. Savings deposit with a 1% annual rate of return. Investment 2. Government bonds with a 5% annual rate of return. Investment 3. Mutual funds with an 8% annual rate of return. Investment 4. Stocks with a 12% annual rate of return. Using the rule of 72, try calculating how long it will take for each investment to double. Share your answers in the comments and identify any patterns you notice. If you're enjoying this video so far, do me a huge favor and give it a like. Number 4. Inflation rate. You may have heard about the current inflation rate in the news, but what does it really mean? Inflation rate refers to the rate at which prices tend to increase over a specific period. It affects the cost of household goods and services, making them more expensive compared to the previous year. The rule of 72 helps us determine how long it will take to outpace inflation. For example, if the inflation rate averages 3% annually, it will take approximately 24 years for prices to double. However, if the current inflation rate stands at 6.8%, dividing 72 by 6.8 gives us 10.6. This means prices will skyrocket within a span of 10 years. By using this rule, you can plan your finances to stay ahead of inflation and mitigate its impact. Number 5. Savings. The rule of 72 also proves advantageous when it comes to your savings. It enables you to project when your savings will double. If you're considering keeping your savings at home, it is risky and prone to loss. Investing in the stock market may offer higher returns but also comes with higher risks. Opening a savings account with a local bank might provide a 1% interest rate, which is usually the least profitable option. To determine how long it will take for your savings to double, divide 72 by the interest rate. For example, a 1% interest rate would result in 72 years for your investment to double. However, there are numerous investment programs available that guarantee a minimum interest rate of 4% to 7% per year. Conduct research, consult a financial advisor, and explore better routes to grow your savings. Number 6. Retirement planning. An integral part of the financial puzzle is planning for retirement. It can be a daunting task, especially if you're unsure of how much you need to save. That's where the rule of 72 comes in handy. It can provide a clear picture of when your retirement savings will double. For instance, if you're planning to retire in 30 years and have an investment yielding a 6% annual return, divide 72 by 6. The result is 12, which means your retirement fund will double in size every 12 years. Now, isn't that an encouraging thought? Remember, the rule of 72 is a tool to help you strategize and make informed decisions. It's crucial to account for inflation, changes in lifestyle, and unexpected expenses when planning for retirement. Always consult with a financial advisor to ensure you're on the right track. Number 7. Debt management. The rule of 72 isn't just for growing wealth. It's also a tool for understanding and managing debt. If you have a loan with a fixed annual interest rate, you can use the rule of 72 to estimate how long it'll take for your debt to double. For instance, if you have a credit card loan with an annual interest rate of 18%, divide 72 by 18. The answer is 4. That means your credit card debt will double in 4 years if you don't make any payments. This stark reality can motivate you to prioritize paying off high-interest debt and avoid falling into a debt trap. Remember, the rule of 72 is a simplistic tool and may not account for all aspects of your debt situation. Always consult a financial advisor or a debt counselor to understand the best strategies for managing and eliminating your debt. Number 8. Real estate investments. The rule of 72 can also be applied to real estate investments. If you invest in a property and its value appreciates at a steady rate, you can use the rule to estimate when your investment will double. Let's say you buy a piece of property for $100,000, and it appreciates at an annual rate of 5%. Using the rule of 72, divide 72 by 5. You get 14.4. This means that in approximately 14.4 years, your property could be worth $200,000. Bear in mind that real estate markets can fluctuate, and this calculation doesn't account for costs such as taxes, insurance, or maintenance. The rule of 72 is a versatile tool that can help you navigate the complex world of finance, from growing your savings to managing debt, planning for retirement, and making informed investment decisions. This simple mathematical rule can be your guide. The rule of 72 is a simplified approximation and may not always provide a completely accurate estimate. It's always beneficial to seek advice from financial experts and use this rule as a part of a broader financial strategy. I hope you found this video informative and empowering. Let us know in the comments how you plan to apply the Rule of 72 in your financial journey. Stay tuned for more practical wisdom. Hit the like button if you found this useful, and don't forget to subscribe to stay updated. See you in the next video.